Good morning and welcome everyone. Thank you for joining the Portland Regional Chamber of Commerce's latest webinar offering designed to provide information and guidance for small businesses dealing with the effects of COVID-19. You're in the right place if you signed up for PPP Forgiveness, answers to your most pressing questions, featuring Greg Fryer and Ben Ford, partners from the Verrill law firm. Some housekeeping items before we get started. This webinar should last about an hour, with the presentation lasting about 30 minutes. We'll provide time after the presentation to answer any questions you may have about this topic or that arose during the presentation. You may enter your questions in the chat section in YouTube. Please sign into your Gmail or YouTube account to be able to join the chat. We have over 200 registrants, so we hope to hear from many of you. If we are unable to answer your question today, you will have an opportunity to reach out to both presenters afterward. We'll be sending out a post-event email containing the information and slides presented today, as well as the contact information for both our presenters. With us today are Greg Fryer, a corporate and securities law partner who advises companies on capital formation, M&A transactions, joint ventures, and entity restructurings. He also frequently assists other lawyers on the more technical aspects of projects involving financial regulations, corporate governance issues, and contract negotiations and drafting. Ben Ford, a partner in Verrill's Employment and Labor Group, helps clients devise and implement policies to access, retain, and manage their most valuable asset, a well-functioning team of talented employees. Ben believes that understanding and navigating the ever-evolving array of employment laws is a strategy for success, not just a way to avoid costly mistakes. Together, they've authored a number of articles on PPP loan forgiveness available in Verrill's COVID-19 Resource Center. Greg was recently quoted in a Forbes article on this topic, with a second one coming soon, and one of the articles on guidance for loan forgiveness math has been read more than 80,000 times. So without any further ado, it's my pleasure to welcome Greg Fryer and Ben Ford.
Well, good morning, everybody. I am just going to share my screen now. And let's see, make sure this works. Okay. Well, welcome to our presentation on PPP Forgiveness. When Greg and I put this presentation together, we thought we would be talking about PPP Forgiveness under the recent rules that the SBA published last week or the week before. You'll hear us refer to something called the IFR, which is Interim Final Rule. We were waiting for these rules to come out for months, and they finally did come out, and we've been processing the information. We've written articles about this. No doubt some of you have sat in on webinars talking about the IFR and how it relates to forgiveness, and we thought we'd put this together as a brief overview to talk about what the rules are, and then to take your questions and try to address as many of your questions as possible. So we had a great presentation all written, ready to go, and then 9 o'clock last night I saw a tweet from Senator Angus King saying that that the Senate had just passed their PPP Flexibility Act, and that was a law that was proposed by the House last week, and the Senate passed it late last night. So then early this morning, Greg and I got up and rewrote the entire presentation. So you guys are going to get a very fresh law here. This is a combination between talking about rules that were introduced in the interim final rule about forgiveness, and also we'll talk about how the PPP Flexibility Act modifies the current program. So we're gonna, this presentation assumes that that you all are familiar with the basic structure of the PPP program. And we're going to make that assumption so that we could spend more time talking about specific provisions of forgiveness. But just in terms of kind of the general scope of the act here, we're looking at a law that was passed on March 27th of 2020. On May 30th, 2020, it's been 64 days out. There's been 510 billion of PPP loan approvals, 4 million borrowers. In Maine, it's been about $2.2 billion of loan approvals to 25,221 borrowers just in the state of Maine. But on June 3rd, like I just mentioned, at around 9 p.m., HR 7010, the PPP Flexibility Act, passed in the Senate. So this has been an ever-evolving program. We're dealing with rules that come out and then are changed and come back out again and are reintroduced, and we're dealing with a constantly moving goalpost here. And so we hope that that this fresh information will give you a little bit better perspective on what's going on. There's key concepts that we're going to be talking about in this initial part of this presentation before we take your questions. We're going to be talking about the covered period and what that means. What period of time can you use the funds and then be forgiven for your use of the funds? We're talking about covered costs, what types of things you can spend the money on. A new 60% threshold or 60% minimum for payroll costs. The minimum for payroll costs was 75%, and the new law that we're assuming the president will sign into law will change that from 75% to requiring you to pay 75% on payroll to now requiring you only to spend 60% on payroll, and that would free up funds for other approved non-payroll costs. Then we're going to talk about the full-time equivalent reduction penalty and how that has changed under the new law. And we're going to talk about the wage reduction penalty, what that means and how that's changed under the new law. And then we're going to talk about what we've dubbed the Hail Marys. Sometimes you hear them called safe harbors. There were 2 safe harbors, and now there's 3 safe harbors. So first, the covered period. Covered period was, under the original law, was 8 weeks, and it began on the day that the funds were dispersed into your bank account. So if you had a PPP loan, the clock started ticking. If you got it on a Wednesday or you got it on a Thursday, that was the first of the 8 weeks, and it ended 8 weeks after that. When the interim final rule came out, what they said was, actually, you can wait to start the covered period until the first day of your next pay period. That made it a lot easier for people to account for how they use the funds, because remember, you have to do all these calculations around your full-time equivalents, which we'll cover in a minute. It was really hard to do the math if your pay period started, say, on a Sunday, but you didn't get the PPP funds until a Thursday. It was tough to do the math. So the SBA came out with a rule that said you can choose to wait to start your covered period beginning on the first day of your next full pay period. This alternative covered period is for payroll costs only. It doesn't apply to the covered non-payroll costs, it also doesn't apply to twice monthly pay periods. So if you pay on the 1st and the 14th, as opposed to every 2 weeks, you still need to follow the original covered period rule. Now, so what was 8 weeks has now been extended by statute to 24 weeks. So Greg, what does that put us out into sometime in October? If you took your funds in early May or late April, and so that really extends the whole program. Next is covered costs, and here the statute says costs incurred and payments made during the covered period. And so what the statute, if you just read the statute, and what that means is that you have to incur the costs and then actually also pay the costs during your covered period. That got a little bit confusing for people because sometimes you can incur costs, but those bills don't come due until after the end of the 8-week period. A lot of this is kind of moved now because really the period is stretched out for so long that it could very well be that all of your covered costs and the PPP funds are exhausted while you're still in your covered period. But if you want, you can stick with the 8-week period. You don't have to extend it out to 24 weeks. And the reason why you might want to do that is maybe you've exhausted all of your funds at that point, and you're going to achieve full forgiveness at that point. And so you might as well apply to have the funds forgiven. So the covered cost is payroll costs, that's salaries, wages, commissions, tips, etc. You got to remember that $100,000 annualized limit applies to your covered wages. So you can't use any of the money to the extent it pushes somebody over that $100,000 limit. That you have to use separate funds for that. Vacations, your vacation time, leave, severance, other benefits. I think we had a question here as to whether 401ks are considered the employer contribution to 401k. I'm assuming is considered a payroll cost, and it is. And so those are your payroll costs. Then there's covered rents. There's covered mortgage interest. The interest only on the mortgage, not on the principal. And there's also interest on, and Greg, you can confirm this, but there's also interest on other loans that cover other types of property as well, not just a land or a building. Then there's also covered utilities. Covered utilities include things like travel. They include your internet, your electricity, your water bill, your phone bill, and things like that. Now, Greg's going to talk about the amount spent on covered costs.
So the goal that many people have is to get total forgiveness of these loans. And in order to achieve total forgiveness, you've got to go through several steps. But the very first step is that you've got to have paid out the entire loan amount on permitted costs within the covered period. Now, for up until last night, that was not necessarily a simple matter for most businesses, but it got a lot easier with the Flexibility Act. The covered period has been extended from being just 8 weeks to being 24 weeks. So now you've got 24 weeks to expend the loan amount on the permitted costs, and for most businesses anyway, that should make things a lot easier. The other tricky thing about spending the entire amount is that although there are 4 different categories of costs that will count as permitted, one of those is more equal than others. That is the payroll costs. The payroll costs, and this was a rule imposed by Treasury and SBA, not by the statute, but the payroll costs up until very recently had to constitute at least 75% of the total the total forgiveness amount. And so if your payroll costs during what used to be the 8-week period happen to come to 70% of your loan amount rather than 75, well, whatever amount you spent of the loan proceeds, you could only get forgiveness for 75ths of that amount. It's a proportional reduction. In addition to extending the covered period to 24 weeks, Congress also is dropping that percent. That 75% threshold is now being dropped to 60%. So between the added time allowed for payroll costs to accrue and be paid and the reduced proportion that payroll costs have to make up out of the total forgiveness amount, this should make the math pretty much child's play. We had written a number of very complicated articles on how you figure this out. It's no longer complicated to figure it out. You're going to get there subject to filling out your application correctly. So that's the covered cost. Can we go to the next slide, Ben? So as I said, forgiveness is a multi-stage thing, as in life, I suppose, true also. And so you start with your loan amount. You have to expend the entire loan amount within the covered period. Of that expenditure, now at least 60% has to consist of payroll costs. and then you run into the next hurdle, which is the FTE reduction penalty. So the basic concept here is that you measure the number of full-time equivalent employees during the covered period. So it used to be that we would measure that during the 8-week period. Now for most businesses, probably they'll be measuring that during a 24-week period. And the way you calculate it is there are several different ways to calculate it potentially. I think the way that's the most correct would be for each pay period. And if your pay period is 2 weeks long, you count the total number of hours spent by an employee during that 2-week period. You would divide by 40 per week, so divide by 80, and that will give you a number. If the number is 1 or above, so for example, if a person works an average of 44 hours a week during that pay period, that's going to work out to more than one full-time equivalent. Well, the rule is that you can't have more than one full-time equivalent. The person only gets to count once. So what you do is you drop that to 1. If that fraction is below 1, then basically you round it to the nearest 1/10. The SBA did provide an alternative method, which for most employers will result in a lower number, and that is that if you're below 1, then you can arbitrarily count the person as half of a full-time employee. Once you've figured out what your average FTE count is for that covered period, you then compare it to a reference period. And the reference period, apologize, this gets complicated, but the reference period is either generally from February 15 of 2019 to June 30 of 2019, or it's from January 1, 2020 to February 29, 2020. You take your pick. You will obviously pick the lower of the period that results in the lowest number because you're comparing your current FTE count against that. You take the two, you divide one into the other. If you have the same level of employment or higher level of employment during your cover period than you did during the reference period, you're good to go. There's no reduction, no FTE reduction penalty. If, on the other hand, your covered period employment is below the reference period employment, even by a little bit, then you're going to multiply the forgiveness amount by that fraction. So it's going to further reduce the total forgiveness amount. Next slide, Ben. So then once you've figured out what the FTE penalty is against your now dwindling forgiveness amount, you apply yet another reduction penalty, which is the wage reduction penalty. And whereas the FTE count was calculated based on the total number of employees you have, we now know, since May 15, we now know that the reduction penalty is going to be computed very intricately on an employee by employee basis. And that's on a dollar amount. So if Sally had an average wage during the first quarter of 2020 of $16 an hour, and if her wage drops by more than 25% during the present period, then there's going to be a wage reduction penalty. If it doesn't drop at all, or if it drops by less than 25%, then there's no penalty as to Sally. Then you move on to Tim. If Tim was making, whatever Tim was making in the first quarter, again, you compare that against what he's making during the covered period, and if that amounts to a greater than 25% reduction, then you can get a penalty. And let me just explain the penalty. The penalty is you'd look at the total number of hours that Tim worked during the covered period, and you would figure out how much more you would have had to have paid Tim during the covered period to get to a point where his wage was reduced by no more than 25%. So it's an intricate calculation that's done employee by employee and results in a dollar for dollar reduction. Although complicated, that's in a way better than the FTE penalty because it's proportional. It's little by little. So next slide, Ben, please. So I don't know if you can see this, maybe a little small on your screen, but this is the PPP Schedule A worksheet. And the reason we've included this slide is it illustrates what all needs to be done. This is for your, so there's a table 2 also. I'm not going to talk about that. Table 1 will be for the people who either weren't employed at all during 2019 or who during 2019 made less than $100,000 a year in total wages or salary. And you'll see what you need to do is employee by employee. You put every employee down. There's a separate line for each employee. The employer identifier is the last 4 digits of the Social Security number. The cash compensation is the total compensation during the covered period. The average FTE is calculated, to determine how many hours Sally worked. Was it on average at least 40? If so, Sally's number will be 1.0. If she worked 30 hours instead, it'll be 3/4 of an FTE. And then you compute the salary, the wage amount that you would have had to pay her in order to raise her wages to at least 75% of what they were during the first quarter. You do that employee by employee, you add them all up into box 1, box 2, box 3. These are pretty intricate calculations, but that's what the application calls for.
Hey, Greg, if I could just chime in for a moment. We've been hearing some anecdotal stories of banks producing their own spreadsheets that would do some of these calculations for you. And I've also been hearing stories of payroll companies producing reports for their customers that might make this easier. So if you're looking at this form and you're being bewildered, it might behoove you to check in with your banker or your payroll company if you use a payroll company.
Yeah, that's a great point. I'm very hopeful that the big payroll companies, ADP, Paychex, et cetera, will mechanize this spreadsheet because otherwise it's a ton of work. And it's ironic because now, under the Flexibility Act, I mean, you know what the answer is going to be, right? You're pretty sure that it's going to be 100% or close to 100% forgiveness. There will be exceptions. There will be restaurants that are still unable to open and can't get the payroll back up to what it would need to be for 100% forgiveness. But for most companies, you're going to get to 100%. Well, that's the easy part. The hard part is that the application calls for you to fill out this very sort of intricate form, employee by employee. That's actually not that difficult a task for a computer to do. For a computer that resides at the at the payroll company. So I'm hopeful that they will come up with programs that automate this, and so they can produce a report that you can just whack on the back of your forgiveness application, and then you're done. If that's not the case, you can imagine a small employer with 287 employees having to fill out, and do all these calculations employee by employee in order to get to the answer that, you're going to get to. That's going to be difficult. I've seen press reports of small business advocates complaining about this and suggesting that if the loan amount was under some figure, under 100,000, under 150,000, that there ought to be a rule that just says you don't need to fill this out. We'll just presume that you're 100% forgiven. And when you think about it, the statute, the latest statute, kind of gets you to that result. But in the meantime, you've got to go through this tortured process that SBA and Treasury came up with. In fairness, they came up with it under the another regime. One thing we've learned, the best advice on PPP has been, sort of like the Maine weather. If you don't like it, wait a minute and it'll change. So this may get simplified at the instigation of Treasury and SBA, but we just don't know. So Ben, I'll leave you to discuss the Hail Marys.
Okay. Well, so we have two Hail Marys, what we call the Hail Marys. I think they're also called safe harbors. The first one was, the first version of the Hail Mary was if you saw a reduction in your full-time equivalents between February 15th and April 26th, then what you do is you count your full-time equivalents on the week that included February 15th, 2020. Then you count your FTEs again on June 30th, 2020, or probably the week that included June 30th, 2020, because it's really hard to count an FTE for a single day. And then if your June 30th FTEs were at or above the February 15th FTEs, then you would see no FTE forgiveness penalty. So even if you were running at lower FTEs during your 8-week covered period, if you were able to get those up by the end of June, then, and this rule still is in effect for those who want to use the 8-week period. If you get your FTEs back up on June 30th, regardless of what their average was during the 8 weeks, if you get them up by June 30th, then there will be no FTE forgiveness penalty. Now that date has been pushed back all the way to December 31st. So now what I'm not sure of yet is whether it's an average or whether it is on the week that includes December 31st, if your FTEs have to be at that level, because that's the week between Christmas and New Year's. And so unless you're in retail, or even if you are in retail, a lot of companies might be closed that week. So hopefully we'll see a rule that actually gives us a little bit more guidance on what that December 31st date looks like. But on the June 30th rule is still in effect if you want to consider your 8 weeks to be your covered period.
Hey Ben,
Yeah.
Couple other thoughts. So I've seen speculation that Treasury and SBA will somehow restrict this. I think that's unlikely, given that the statute very specifically says December 31. But note now that the words that were always in there, was the concept that it would be by June 30.
Oh, right.
Now it's by December 31. So if you're able to restore your head count by, the middle of August, and then you apply for forgiveness, then you may, well, actually by then, if you're in the 16-week, if you're in the 24-week period, maybe not August, but September. Anyway, point is, by the time you apply, if you've restored, you may not have to wait till December 31. If you think about it, there are lots of different kinds of small businesses, including seasonal businesses. There are seasonal businesses that are shut down by December. So their December 31 headcount would be, pretty close to zero.
Yeah, that's
so,
right.
So I expect there will be some flexibility in determining this.
Yep. Okay, the other Hail Mary is the wage reduction. So if you've had overlapping employees and some have suffered a drop in salary or wages between that February 15th and April 26th, and the drop was more than 25%, after that. So it's more than 25% drop in wages and salary rates during the covered periods compared to the first quarter of the year, then there would be a penalty. But if you bring those salary and wage levels back up by June 30th, or in this case now December 31st, you bring that back up to 100% of where they were on February 15th of 2020, then you can ignore the wage reduction penalty for that particular employee. And it's really important that this goes employee by employee. There's no average that applies here. So if you have one employee that has a that you've reduced salary or wages for, then your forgiveness will be affected by that amount that employee has dropped in salary above 25%.
And again, you've got the question of, by what date? And I'm hopeful that if it's been restored by the time of the application, that you don't have to wait around to December 31 to prove that it really was restored.
Right. And this, what we're calling really a new Hail Mary, and we read the raw bill. I read the raw bill that was passed last night, and it looks like the way they're codifying this is as a new safe harbor, a new Hail Mary. And what this one says is that in the interim final rule, they allowed you, the SBA is going to allow you to count the FTE numbers of employees that you cannot rehire because they can't come back or they don't want to come back for whatever reason. You've offered them in writing their job, their full employment job, but for some reason they cannot return, and you cannot replace that person, or you haven't been able to replace that person. You're allowed under the SBA rules to include that person's hours in your FTE calculations. That has now been codified in the new statute, in the new flexibility statute. And also it adds, this new Hail Mary adds a new inability to return to the same level of business activity. This is a big catch-all for restaurants and retail companies that have had to close, and maybe they're under some rules that restricts them from being able to conduct their business fully again. So I'm thinking mostly like restaurants, but other types of maybe concert venues and things like that. But the statute is written to really only look at the federal guidance, federal requirements. So it specifically says Health and Human Services, the U.S. Centers for Disease Control, not the Maine CDC, the U.S. CDC, and OSHA. Now, will we see guidance in the future expanding this to state level, the equivalent state level agencies? I guess I wouldn't be surprised, but the law itself only references these federal agencies. The orders have to relate to the maintenance of standard for sanitation and social distancing or any other worker requirements related to COVID-19. So it can't be just random regulations that are restricting your business. They have to be regulations and guidance that are focused on COVID-19. And the regulations have to have been, or guidance have to be issued between March 1st and December 31st, 2020. So again, we think that with the new rules and the new statute and this new safe harbor, we think that the incidences of businesses that are not going to be fully forgiven for this, or the numbers are getting smaller and smaller and smaller, because it's getting harder and harder and harder to get penalized for not doing the right thing. The only exposure now, assuming that you can do all the math and complete all the spreadsheets, your worst exposure now is not spending the money appropriately, and that's why it still remains really important that you keep track of what you're doing here.
So Ben, let's turn to well, why don't you wrap up this slide, and then we'll turn. We've got a bunch of questions that I'm eager to get to. So
me too. So just really quick. The interim final rule came out with some timing expectations. Agencies are generally not held to their own timetables. So, whether this is real or not, we don't know. But your bank is supposed to, once you fill out the application for forgiveness, Your bank has 60 days to process the application, and then they issue their decision on forgiveness to the SBA. The SBA then has 90 days to review the application and then remit those forgiveness funds to the bank, and the bank then forgives your debt. Whether or not they can hit those deadlines, there's a lot of loans out there, so we will see. So that's what we have there. Now we want to start. Question.
Ben, if I could just interject on the timing. I've reached out to a couple of accountants on how this shows up on a GAAP balance sheet and income statement, and their answer is, at least under the current guidance, which is sparse, that you don't show the forgiveness until it's official. So you may have to wait for that 60 plus 90 days. You may be waiting a while, even when you know that that line item that shows up as probably debt on your balance sheet, that's going to get forgiven. It's going to be a while before you're actually able to record it as such under GAAP. So let's turn to these questions. Ben, why don't we haven't really rehearsed any of this, obviously. So why don't we each alternate back and forth, and that way while I'm blabbing on, you can figure out the answer to the next one, and then vice versa. Okay.
Okay. Sounds great. You want to take the first one, Greg?
Yeah, so let's take the first one. So question is, does a company contribution to employees' 401k plan count as part of the payroll under the PPP? Answer is definitely yes. However, these 401k plan contributions are notoriously lumpy. And so back when the covered period was 8 weeks, I would have had real concern if you'd made the 401k plan contribution for an entire year and tried to take credit for that. Well, now that the period has been extended to 24 weeks, you're probably under less pressure to find, payroll costs to fill up what is now a 60% bucket minimum. And so this question becomes less important probably, but we don't have great guidance on whether you'd have to prorate this. My gut is that you'd still have to prorate it. It may be that things that are lumpy, in monthly or bi-monthly amounts, you can get away with some, spillover. We actually know that you can get away with spillover, but on something that's an annual contribution, anyway. So hopefully this question becomes less important now with the new periods.
Yeah, and prorating it would be really just a matter of figuring out what the annualized cost is and then multiplying that by the number of weeks of the forgiveness period, right? So it's a matter of just putting the correct number in on the application. The second question is, if staffing changed since we received the PPP due to issues unrelated to COVID-19, for example, if the staff took another job, how do we handle the disparity? So here's what you do. What you do is you submit to that staff person a written offer of their job back. And if that person refuses that, you want to get that refusal in writing. So do it by email and just save the email. And then if you want to try to hire, you want to try to be able to hire a new person, obviously, because you have a business to run. But if you can't hire a person to replace the person who hasn't come back, you can still count that person's hours, the amount of hours that they would have normally worked in as you can count that into your FTE calculation. But again, some of this is sort of looks good on paper, but then there's some practicalities involved. So yes, you have to, if you're running a retail company or you've got, you've got a job to do, that means that you're going to be looking to rehire somebody, and to the extent you rehire somebody to fill that person's position, then you're not going to include those FTEs in your calculations. But if you can't find that person, then you would. It gets a little weird though when you think about how like a company might work in teams. So maybe there's a call center, and the call center has a team of 5 people, and a 6th person can't come in or is not coming back. Does that mean that you count the 6th person's hours if those other hours are being absorbed by other people? And we just don't have an answer for that yet. we're going to wait for the sort of granular level guidance on that type of question. But when it's a discrete position, an assistant manager or a production supervisor, and you can't fill that position, then you can go ahead and count those FTEs.
So I'm going to take the next. So we're measuring questions by number of question marks.
I'm doing it.
Do I need to fill out an application for loan forgiveness, and by what deadline? If so, where do I get it? So answer is very definitely, forgiveness does not come on its own. You have to apply for it. Your written application needs to be supported by documentation. That application and the supporting documentation have to go back to your lender. The lender then has a period of time. They have some level of review that they have to make of the application to see that, at least on its face, it kind of hangs together. And so that's the basic process. The deadline, as Ben said, has now been extended. You won't be required to file it until sometime in 2021, but you'll want to do it earlier if you're able to. I think that's where do I get it? So one place to get it is to go onto the Verrill website, look for the articles on PPP. There's one that's titled "Finally Guidance on Forgiveness." That contains a cross-reference to the forgiveness application. You can also get it through the Treasury Department website or through the SBA website. If you got to hunt around a little bit, probably best to just run a Google search and see if you get lucky. And if you can't find it, give us a call and we'll get you to the application. By the way, the application will change.
Yes.
So the application was published May 15. It's going to be completely revised. So
yeah, and your bank may have a different application as well. So that's also
You, as Ben said, you are allowed to elect the 8-week period. If you're done, if you figure it all out, you've done all the work, you plotted it all out, you're at 100% or close enough, and you just want to be done with it, you should be able to use the old application for the 8-week period. But for everyone else, which will be most people probably, new application. So stay tuned.
Okay, I've got our equipment rental expenses still eligible for forgiveness as outlined in the SBA interim rules. Yes, they are. Equipment rental expenses should still qualify. Nothing's changed in the IFR yet. So if it was in the IFR as of last week, then it's still going to be there now. We're going to keep watching that. I think it's going to be hard for them to take away expenses that they were permitting in the IFR. So I would expect to see those mostly to expand. I think we've already talked about benefits already, cafeteria plans for health, dental, life, and 401k plans, admin fees. Those are payroll expenses, but expenses for travel are probably going to be considered non-payroll expenses. So even though you're reimbursing your employees for the travel, like a per diem mile or per mile, that's probably going to be a non-payroll cost. So that's going to come out of the other side of your PPP funds.
So one important piece of advice, I think, is that as you get deeper into the weeds on what's a covered utility, is my cell phone bill covered, that kind of stuff, there's going to be stuff that obviously falls within the category. And then there's going to be a continuum where you get, greater and greater uncertainty. Well, now the math is much simpler, and you probably don't need to go very deep into all these other costs in order to, reach 100% forgiveness. But the advice would be, if you need those costs, you should probably tier them and stick with the ones that are right in the middle of the bullseye first, and see if you need to go farther than that. And then as you need to go farther than that, look for supporting authority. But you probably won't need it. Most businesses probably won't need it because you've got 24 weeks now to spend 2.5 months worth of payroll. So
Yeah.
should be easy.
That's good advice. It should be easy. We get this one a lot. What are the rules on offering bonuses, raises, or additional pay to employees during the 8 weeks? If working from home, are they still forgivable? The IFR that came out last week expressly said that yes, you can pay people bonuses. Yes, you can pay people more money. That ability is great, but now it really conflicts with the new statute, because now you have an incentive with the new statute to really run that payroll out as long as possible. It used to be that you had to spend that money as fast as possible in the 8 weeks, and now you have got the flexibility to run it out longer. So, if you've already committed to your staff and your workers that you're going to pay them more, or a hazard pay or a bonus, then yes, absolutely do that. Do not go back on your word on that. That's advice from lawyers. But if you haven't yet committed to doing that, then you may consider actually just using those funds to stretch those funds out longer, and keep more people employed, or maybe help your business run more securely throughout the summer.
So another fundamental piece of advice all the way along has been, first rule is do what makes sense for the business. The availability of forgivable loans probably distorts your business decisions to some degree, and it's intended to. It's intended to have you keep people on longer or pay people a little bit more than you might otherwise feel you needed to. This area of bonuses, if the bonus really was intended as a thank you, as sort of combat pay to people, then it is what it is. It turns out that you didn't need to do that, but hopefully you had a good business reason, a good employee retention, reason for offering the bonuses to begin with. So, not a bad thing. The other thing about bonuses is, and again, this is now no longer as necessary, but I had clients ask whether they could pay bonuses on the understanding that that they'd get it back later, essentially prepaying, an August, bit of compensation. The answer was definitely not. The bonuses need to be from the heart. They need to be current. They need to be relating to the current circumstances. And if you go beyond that, watch out.
Yeah, and really don't try to game it. It's that ultimately, if there's a question, you can ask a lawyer, you can talk to your bank, you can fill out your application, but flag the issue for your bank so they know what you're doing, so that everything's on the up and up. But yeah, definitely don't want to game that. Greg, do you want to pick another question?
How are employees handled who apply for and granted paid leave under FFCRA and enhanced FMLA, where the pay was covered for 2/3 pay for childcare? I actually don't know the answer to that. I do know that to the extent that an employer got a benefit under the CARES Act, you can't count it twice to the extent you get a tax credit. But Ben, do you know the answer to that?
Yeah, you do not count those FTEs in your PPP forgiveness. So if you have employees that are out on the FFCRA and you're taking the tax credit for that, like they can be out on FFCRA and you could be paying them and that's fine. But if you're taking the tax credit for that, then you would not include those hours in your FTE calculation. You can't get benefits for both of those.
Yeah, it's interesting. The FTE calculation actually refers to hours paid, not hours worked, hours paid. So if somebody's out on vacation and you're paying them, for 40 hours, a normal 40-hour week, that still counts as an FTE. Unless, of course, you're not paying with your money, you're paying with the tax credit. There may be an exception.
Yeah. How about this one, Greg? Maybe you can talk about this. I think you and I have had a conversation about it. Please clarify paid/incurred costs. If utility bills were paid at the beginning of the covered period for services incurred prior to the covered period, are those costs eligible for forgiveness?
So here's an area where a lot of people, myself included, just kind of freaked out over the statute, because the statute very clearly talked about, costs incurred and payments made during the covered period. And so, gave a lot of advice that in retrospect turned out to be too conservative. The guidance that came out in the middle of May makes it very clear that for non-payroll costs, if the amount if the payment fell due within the period, even if it was a retroactive payment, and it related to stuff that happened in April or March, if it falls due, if it's either incurred or paid within the 8-week period, then then it works. Even though so they expressly allowed a little bit of slop over, where everything wasn't tied exactly pro rata to the 56-day period. So there is some slop over. Paid or incurred is the general rule when it comes to non-payroll costs. It is not the rule when it comes to payroll costs. But then again, now that you've got 24 weeks to accumulate expenditures of your loan proceeds, this becomes a less important question.
So the next one is when calculating FTEs during covered period, if all employees working 32 hours versus 40, would we be dividing by 32 to determine the FTE number? And the answer to that is no. You'd be dividing by 40 to determine the FTE. And this is a critical difference. When the rules first came out for this, when the statute was first passed, there was a lot of people out there saying, well, let's follow the rule under the ACA, under Obamacare. And under Obamacare, it's 32 hours is considered a full-time employee.
30.
Excuse me,
30 hours.
30 hours is considered a full-time employee. So there was a ton of advice that went out there and said, oh yeah, 30, 30, 30. And then bam, it was 40 hours. So it is 40 hours. So in the case where you have a bunch of people working 32, then you would add those up and divide it by 40. So your FTE number will go down. But remember, it's a comparison. So you have to use the same method for your comparing period. And if you use the same method for your comparing period, then the hit shouldn't be that great.
That's a subtle thing about this. I mentioned the alternate method that SBA allows, where if the person works fewer than 40 hours, you can count. You don't have to compute to the 10th of a person how much employment you have. You can count the person as half, and you say to yourself, well, why would I ever count them as half if they really were 0.75 or 0.8 or whatever? Well, the answer is, it is a comparison, as Ben notes, and it might turn out. I mean, you might want to, if things are close, you might want to run the calculation both ways, because although it gives you a lower number in your cover period, it also may give you an even lower number in your reference period. And if it gives you an even lower number in your reference period, it could save the day. So all of this it all comes down to math, but it can be pretty subtle.
Yeah, absolutely. So next question is, now that we can use 24 weeks of payroll costs, did they increase the $100,000 max? The answer to that one is no. It's still $100,000 annualized, right?
Yep.
And then salaried employees, do you just assume it's 40 hours? For salaried employees, yeah, you would assume that they're 40 hours, assuming that that's what they normally work is for 40 hours. You might have a salaried employee that's not full-time. They're just paid a fixed amount of hours. And in that instance, you would just look at the hours that they would normally work.
So, for example, there are law firms and other businesses where rank and file employees work 37 and a half hours instead of 40. Well, so they don't count as they may be salaried, but if they're expected to be there 37 and a half hours and no more, in terms of hours worked, they're not 1.0 FTEs. There's some fraction of that. But if the same was true in the reference period, it should all come out in the wash.
It all comes out in the wash, yeah. How about that one, Greg, is short-term disability, long-term disability, life insurance included in the benefits included in forgiveness as payroll costs?
So if it's an employee benefit and it's funded by the employer, I think it's covered. But I do recall seeing guidance that says that insurance is not covered. So obviously health benefits are covered, retirement benefits are covered. Whether insurance benefits are covered, I'm not sure. Do you know the answer to that, Ben?
Yeah, it is covered. Insurance is definitely covered. So short-term disability, long-term disability, life insurance is covered. Also, workers' comp is covered too. That's a big expense, and that's covered as well. So you should be okay there. But again, your bank, the lender is going to be the person that's really going to look at this. So if you have questions and you're still not sure after talking to us or your own lawyer, your lender really is the person who you're gonna go to for those types of questions. There's one more there. If we elect if we elect 24 weeks, can we submit once funds run out, say at 10 weeks? This is a great question. I can only speculate on this. What do you think, Greg?
I think no.
You think no? You think you have to wait the full 24?
Yeah,
I think
because the FTE count could drop, and that's, you know, if you had to wait the full 8 weeks, so I would think you'd have to wait the full 24 weeks.
Yeah, I mean, I wouldn't be surprised if they let you do it. And the reason why is, you know, I guess if the goal here is flexibility, then maybe, you know, they would want you to be, then maybe the SBA will say, well, we want to be flexible too, so we'll let you apply for forgiveness at the end of the week. The answer is we don't know exactly, and we can only sort of speculate as to what's going to happen. An argument in favor of your point of view, Greg, is that, you know, the statute gives you the option to do 8 weeks. And so, you know, it's an either or decision on your part, either 8 weeks or 24. So stay tuned on that one. More guidance.
Yeah, and the statute doesn't say up to 24 weeks. It says 24 weeks. So I'll bet you a cookie on this one, Ben.
All right. I may owe you a cookie. I'm self-employed with no employees and no payroll set up. What is the best way to pay myself from these funds, and how do you document this?
So I've just written an article about that last week. So take a look at the article, and if you still have questions, why don't you give me a call?
Okay, we're getting the hook. So thank you all very much for your questions. They were fantastic, and we really appreciate you tuning into this. We have recorded this presentation, and there will be a wrap-up email that's going to be sent out by the Chamber that will contain the information that you need. It'll also contain the slides that we presented, and it'll also contain Greg's email address and my email address. And so if you have questions, we really hope that you get in touch with us. Any last words, Greg?
Don't read any of our articles. They're all wrong now.
Thanks, everybody.